Hello, everyone. My name is Phil Blancato, and I'm CEO and President of Ladenburg Asset Management, Chief Market Strategist for Rosaic. Welcome to another Weekly Market Impact. Well, here we are racing through the holidays, and today is the 15th. And why I'm going to start with the date, because all you know me well enough. You have one more week, just 1 week left of darkness. Because in just a week, every day starts to get a little bit brighter. So we'll talk about the solstice because I'm so excited it's going to be on the podcast this year, which will be the next podcast will be all about it. So I won't waste time on the solstice today, but you got 1 week left. And then we turn the dial and suddenly every day gets a little bit brighter, which, me, I've always been fascinated by that day, but I won't bore you. Snow. We have snow in New Jersey. Can you believe that? We haven't had a lot of snow here in a while. And a lot of snow being, I don't know, some amount that is relatively significant, meaning you got to get out a shovel. So it's kind of a crazy story. My older daughter, Luca, as you know, is home. They're both home. Both girls are home. I'll get into that in a second. But she had some friends over here on Saturday night, and sure enough, we wake up Sunday morning to just about 6 inches of snow. It was fun. It was good snow. You can make like snowmans and that kind of stuff. So we had quite a bit of snow for the first time in a while, and now cold. And in just a minute, you're gonna hear from my partner Jaime Desmond is gonna be one of my guests today. It was 16 degrees when she left her house this morning, and right now in my house it's only about 22, so it's chilly out there. One new personal note, both girls are home. They actually just left for Denver to go skiing, but there's more snow in New Jersey and Vermont, East Coast, than there is in Breckenridge, but they're going with the school, so they'll have fun. But on a personal note, we have a new addition to our family. Oh my gosh. For those of you who have heard me talk about our dog over there, my wife, who grew up never having any pets, she's become a dog owner for sure. And sure enough, we have a new puppy at home. The new puppy's name is Whiskey. It's the same kind of breed, they call him a Cavapoo. It's half a King Charles Cavalier, half a poodle. But what makes the dogs fun is they decide on naming the dog Whiskey because my dad, God rest his soul, instead of saying cheese, would often say the word whiskey. That's just, I don't know why. I never asked him. He just thought that was a better way to do it. I kind of regret not asking him. But anyway, cute little dog. And yeah, as you know, with puppies, it's a lot of work. So my wife has her hands full. But that's the new Christmas addition to the Blancato household. Anyway, snow and then puppies. And the last but not least, SantaCon. I don't really know what SantaCon is. My actually older daughter went. And there's some videos out there about SantaCon. This year they had a gigantic crowd. If you've never seen it, when you get a chance, go Google SantaCon. It's this kind of party in New York City and many areas of the country now, but where this massive amount of kids dress up in holiday outfits, little elves or Santa suits or whatever. The Grinch is the popular one. And sure enough, they go all throughout New York City at restaurants and bars and have a big party. Well, this year it was cold. It was in the 20s and the 30s with some snow. So they had one heck of a cheery, cold time. But if you haven't seen it, my older daughter went and she was dressed up as a Santa elf, I guess, and with her four friends. And it is a fun kind of rite of passage here in the East Coast. And sure enough, it means the holidays are in full gear. In New York City today, we try to walk outside our office and it's just packed. Try and get a restaurant reservation, packed. The Rockettes lines every single day because we work right there. So really kind of a fun, exciting time of the year. And I think a little bit of snow is great. And hopefully it sticks around till Christmas. I don't think it will. It's going to warm up finally. We may get to 50 on Friday, which is a big deal. But anyway, I thought I'd give a quick market update. So a lot going on in markets. This time of year tends to be generally a bit slower. You don't get a lot of craziness this time of the year. But that's not the case right now. And the reason why, remember when the government was shut down, we were kind of flying blind with data, that we didn't have a lot of data to reflect on. And because the government was shut down. So this week we're going to get quite a bit of data, and we got some data last week on JOLTS, the number of jobs available. So that was interesting to see that the number came in and actually rose to 7.6 million jobs. Then we had news about the Federal Reserve last week that cut interest rates. That was highly anticipated. But if you think about it, we've cut interest rates 1.75%. What that means is when people go to borrow money, the federal government sets an interest rate standard. So in other words, by raising interest rates at the federal government's level, the amount it costs to borrow, in simple of term, it's harder to have a credit card or an auto loan or a mortgage. We generally raise interest rates when the economy is running too hot. We do that to slow down lending. And then you cut interest rates generally to spur the economy, get lending going, get people to borrow more. This time it was a little different because this time it was much more about a supply shock, which created inflation, all this extra money that was printed. So a little bit different inflationary scenario this time, which, if you remember, we've talked a lot about that over the years. But now the Federal Reserve has cut 1.75% out of interest rates. And why that's important is you can basically, the interest rates are now set at about 3.5%. So if you add on 2% for a mortgage to a degree, it works that way, you're probably looking at mortgage rates coming below 6 here, which is a good sign for the housing market. In fact, housing sentiment, new housing construction came in higher this morning. So the idea that new building construction, we're underserved in a number of houses built in the United States. We don't have enough of them. And it's a lot that has to do with our demographics, a lot has to do with the cost of mortgages. It's a good sign because new homes take a lot of stuff, lumber and obviously concrete and bricks and nails, and most importantly, people. So building new homes is very important. Having the Fed cut interest rates was very supportive of the market. It's why we had this really wonderful market rally here most recently. And even though it's kind of a mixed bag now, next year we'll get a new Fed chair, new members. So it looks like they're probably not going to get a lot of cuts unless things change in the U.S. economy. But we've come a long way. When we talked about the Fed a lot, we're not talking about as much anymore. We're looking at GDP forecasts right now, somewhere around 2.3% for 2026, which is a good number, not a great number, a solid number. Could be a little lower, but I would expect it to be on the high side. Ideally, it would be closer to 3% GDP growth if some of these benefits of the one big beautiful bill happen. Lower taxes, lower tips on wages, Social Security, so on. Then we might get a higher growth rate than that, especially if there's a manufacturing renaissance, building new buildings. We talked a little bit about AstraZeneca, its new cancer production plant for cancer drugs in Maryland. That's one example of the many. My point is, there's a lot to start thinking about with the Fed cutting interest rates. It does spur growth, and I think that's pretty exciting that we're in that scenario. We'll also get jobs this week. We haven't had a real jobs number in a while. So this week we're going to get initial jobless claims, continuing claims, and more importantly, the current unemployment rate. We're also going to get information on inflation, CPI data. So a lot's going to come out this week, which will tell us, was the Fed justified in cutting interest rates? For example, let's assume that the labor market does really well. We have a better than expected labor number. It's probably not going to happen actually. Then the Fed probably maybe have overthought cutting rates because they expect the labor number to be weak. If the number's too weak, then maybe they didn't cut enough. In other words, I would expect this week's round of data to give us a little bit of uncertainty or at least some volatility, unless it all comes in Goldilocks. For example, I'll give you a number. Last week we had continuing jobless claims, people who file for unemployment and continue to get it, at 1.8 million. That's a really good number. That's the lowest number in the last 8 months. I was getting very concerned that number was getting close to 2 million. So when I see that number go lower, it's a good sign. Now, there could be some seasonality in that, the time of the year. People will get employed for holiday season only. So don't ever let one data point dictate policy. You want to be very careful. In fact, I'd argue the gist of today's call, the first take I want you to have is, are you rebalancing? Are you taking this time of year to look at, do I own enough small caps, which have been on one heck of a rally? Do I own a balanced portfolio? I own some dividend paying stocks. Do I have some fixed income, which has been a pretty solid place to be this year? So my number one takeaway for this week is the Federal Reserve cutting interest rates means the rest of the U.S. economy will probably do pretty well. So let me give you an example. On a year-to-date basis, when you look at the Magnificent Seven, believe it or not, there's only two that are beating the S&P 500, just two. And that would be Alphabet and NVIDIA. Think about that. We have been in this sort of tech-driven rally for a long, long time. And other stocks did better this year. I'll give you another example. The Russell 2000, which represents small cap stocks. You have expected earnings growth next year between 40 to 60%. That's mind-boggling. That means that you're going to see earnings grow up by half. And yet earnings for the S&P 500 should be just around 13 to 14%. And you look at valuations, which one's cheaper? Small caps are cheaper than large caps. So you see these kind of opportunities to do something different in your portfolio. And even recently, small cap performance has almost caught the S&P 500. I'll get into that in just a second. But I think we're in this unique moment here And with just a handful of trading days left, I mean, today's the 15th. We've got basically 10 days left, a little more, 11, 12, whatever the exact number is. But my point is rebalance your portfolio. Think about what you're positioning for 2026. And we'll get into 2026 positioning more in the new year. But certainly, when you think about recent data that suggests the Fed should cut, now we're saying we're going to get a lot of data this week, which should bring some volatility. You've got opportunities in other names besides the Magnificent Seven and small caps doing well. Answer is rebalance your portfolio. And by the way, inflation, latest rounds of inflation have suggested inflation is not a big deal. So if that's the case, it means there's a lot of places where you can make your bet on interest rate sensitive securities doing well. For the week, when I look at how things have gone, the S&P 500 had a bit of a softer week. The Fed cutting rates was already baked into the market, so the S&P was down 0.61 on the week. There's some concerns about an AI bubble, and I'll touch on that in just a second. Uh, when you look at things like the Russell 2000, now get this, the S&P was down 0.61. Small cap stocks were up 1.2. Large cap growth stocks were down 1.55. Large cap value stocks were up 0.62. So now you understand my point about rebalancing. Other areas of the market did much better. Last week, I think, is very emblematic of what 2026 could look like. Heck, international was even up 0.85 last week. And you look at the bond market, while recently giving back a little bit, still up 6.7% on the year. I thought we might get a 9 or a 10 out of the bond market. That's not going to happen. But we might get a solid 7, maybe an 8, depending on how these last 10 days go, which is still a great number. So I think that's pretty exciting. Two headlines I want to hit on before I bring on my invited guests. I've got some great guests on with me today, and I'll get to that in just a second. I did read a really interesting report about electricity. And electricity is a tough one because I think there's a bit of an electricity rebellion that might happen because data centers are starting to absorb a lot of American electricity. So if you look at the cost of electricity from, call it 2020 forward, you have electricity that's only about 0.5% annually, very little. Electrical costs are generally controlled. But over the last 10 years, there's a trend with electricity up being on average 3%. And it's not because of the prior five, it's because of the most recent five. In other words, the last 5 years, electricity overall is up 6% and inflation's up about 4. The forecast is inflation to fall back below 3, but electrical costs will be up close to 5% year over year. And in fact, the last 1 year, depending on where you live, they're up anywhere from 15 to 18%. Why? Data centers. As AI becomes the predominant sort of driving force with electrical demand, and we need more power than ever before, there's no doubt about that AI is adding to the mix. So, for example, if you do a general search for something on the internet without using AI, and then you use AI to do that same search, AI will take 10 times more power than the regular way of searching for something. So, in other words, AI is increasing the electrical demand for answers on the internet 10 times higher, tenfold. That's a big number. So it makes you pause for a moment. Does that make sense? Well, I think folks can get mad at it at some point. And if you haven't looked at our stuff, we do this fun thing called Chart of the Month. The Chart of the Month has this cool thing this month. We're doing AI and how many times they hallucinate. And believe it, Perplexity, which is the number one sort of large language model, large chat model, is only right 60% of the times, or put a different way, it's wrong 40% of the time. Gronk 3, the newest Twitter version or X version, is wrong 90% of the time. So you're going to use 10 times the amount of power, and yet 40% of the time your answer is not right. Now we've used it quite a bit, and it's very helpful. But you want to double check your answers. My point is, when do people get mad? When's there a rebellion on this stuff? When do they get angry that they're paying so much for electricity? And it's going to take a long time for new power to come online, nuclear and to a degree coal, certainly gas, that are all these new power sources, hydrogen. Those things take time to build. So I wouldn't be surprised if electricity becomes a sticking point with folks and keeps inflation a little bit higher. And do people get mad about too much AI? And I'll add to that. There's been so much talk about an AI bubble. And I don't think so. I think these companies generate a lot of revenue. I think AI is here to stay. It's having an impact on productivity. It's going to make us all personally more productive and at work. But we do know there's a lot of money being spent And just to give you one little thing that sure keeps me up at night and why I want you to rebalance, why I want you to buy other stocks than just the Mag 7. I want you to own some value stocks and some small caps, some international. I want you to own some bonds. It's because when you compare the current price to earnings ratio, and we've talked a lot about that, a price of a company divided by how much they earn. Well, at the dot-com bubble, at the height of it, when the internet kind of came out and then we had a big crash there for a little while, price to earnings were 24 times. What is the current price to earnings of the S&P 500? Oh, about 23 and a half. What was it at the height of the SPAC bubble, which was just before the pandemic? 23 and a half. So you look at some of those things and it makes you a big concern. Cisco Systems, kind of fun analogy, which is the backbone of the internet, during the 2000s got to about $80 a share. Where is Cisco today? About $80 a share. It corrected post then. It took basically the entire 20 years to get back to where it was. When you look at small cap stocks, which are really powering higher, especially those small caps I mentioned, when you look at how much their value is versus other companies in the S&P 500, well, guess what? They're starting to look like dot-com bubble-ish as well. I'm not suggesting we're in for a correction, and I do think this time is different because these AI companies make a lot of money, and it's not like in 2000 when they didn't make any money. But certainly, it gives you a little bit of pause. And what does that pause mean? It means diversify, take some profits. It's okay. It's okay to take profits. You'd be surprised. Profits are not the worst thing in the world to have. They're a good thing. All right, enough of my ranting, enough of my weekend. Now we're do something fun. As a follow on to last week, I work with some extremely talented people. And last week you got to hear from Ben and from Lucas on their topics of the year. This week I'm going to bring in first I'll start off with Matt Crosby, and then I'll bring in my partner Jamie Desmond. Matt, welcome to the show, buddy.
Thanks, Phil. Glad to be here.
How was your weekend?
It was pretty good. How was your weekend?
I told you, snowy, cold, crazy young lady around, a couple of drinks. What did you do? Anything fun?
No, I my girlfriend just flew out to Oregon to see her parents, so I drove her down to the airport. Other than that, about the same. I drove for snow in the first time since I've lived in Colorado, so I had to get used to that again.
Yeah, Matt's a interesting guy. Did you go running this weekend? Usually get your 5 miles in at some point.
I did 3 on the treadmill,
Yeah,
but
a little cold.
not outside this weekend.
It's a little cold out. As you know, Matt's one of the analysts with us under at Ladenburg Asset Management. A very talented young man, working on his CFA designation, someone we rely on quite heavily here. As we go through the tariff, as we go through our topics for this year, I asked Matt what he wanted to talk about. And you remember, we do these really interesting, we call them white papers. They're hot topics that we do every single month. And now we do these wonderful charts of the month as well. All this is available to you at ltam.com, by the way, or contact your financial advisor. If you have one with Osaic and they can get it to you, but certainly we can get you this information. It's available out there on the World Wide Web. But Matt, let's jump into one of the topics you hit on was tariffs. So let's start there. Tariff could probably be the word of the year. I did hear the word of the year was this kind of like a bizarre angriness about the internet. I like your word about that a lot about tariffs. Can you give us a recap of how tariffs unfolded and the impact that it had?
Yeah, sure. So I think really if we want to start with where tariffs were, we have to look back at 2017, 2018 and Trump's first presidency. That was kind of the first time we'd seen or heard of tariffs in decades. But coming into the second term, we knew it was going to play some kind of role on the economy. We didn't think it was going to be necessarily to this extent. So around February and March, that's when we started having serious tariff conversations with primarily Mexico and Canada, our two largest trading partners. And there were discussions over energy prices, there were discussions over immigration and fentanyl coming into the country, and all kinds of these different leverage points that weren't purely economic, which is how tariffs have primarily been used throughout history. But really, what drove fear into markets in the first part of the year was Liberation Day on April 2nd. And that's when the White House came out with a long list of reciprocal tariffs on a number of different countries. And that really spooked markets. Markets to that point through April 2nd sold off from their all-time high back in December of last year. They sold off over 20%, which officially for a short period put us in a bear market. However, they recovered very quickly throughout the rest of the year to where they are now up 18 almost percent on the year because in May and April or sorry May, June, July and throughout the rest of the year, what we saw was a lot of negotiations come on into play, and we saw those tariff rates that initially seemed like they had a high sticker shock start to come down into something more normalized, and I guess what we would have anticipated coming into the year.
Yeah, it
So it's
seemed
been
like
a
there was
very
a
wild
rationale
ride.
around there was a rationale around coffee and things that we don't make that suddenly we got to some better conclusion to keep some of these prices down. How much money is the federal government making to this point?
Well, tariffs collection of revenue collection has been on pause while everything's tied up in the Supreme Court, but roughly 300 billion is kind of what we've earned year to date so far.
And if you don't know, everybody, the Supreme Court is looking at this and trying to figure out if, in fact, some of this stuff is not allowed to be done by the president. It's not all of them, by the way, but a portion of them could be that way. What do you think the sum total is on the average person out there, Matt? I mean, we've talked a little bit about what we think the effect might be. What do you think what does it mean for the average person out there?
So I guess a tariff in general, whenever a good is imported into the country, the firm that imports it has to pay a tax to the U.S. government. So the question with tariffs in general was who's going to end up being the net recipient of that? Is the importing company, that U.S. firm, going to pay this? In which case you might see margins decline, or are they going to pass the cost on to the consumer? Or is the country who sent us the good that we bought, are they going to just lower their prices and they'll pay for it? And the answer has kind of been a little bit of all three. The consumer has seen prices raise a little bit, about 2% on imported goods. We've seen corporations take on a little bit of it. We've seen them change up their pricing schemes a little bit, and we've also seen those exporting countries who send goods to the U.S. pay a little bit. So what that has meant for the end consumer is that it's kind of been a muddled effect. We haven't really seen these super high price increases in the same way on corporations. We haven't seen margins decrease drastically because we're kind of splitting how the impact is shared.
Yeah, and there's certain areas that have been hard to fix. Think about the U.S. economy. On one hand, inflation and insurance have been painful, but tariffs on the other hand have also added a little bit of cost. Not a lot. We haven't seen a ton of it. I guess to Matt's point here, it depends on really what you're looking at and the average person out there, and whether it's going to cost you a few dollars. We don't really think it's very impactful for spending. We haven't seen the consumer worry at all. We had, back as mentioned last week, increased Black Friday and Cyber Monday sales of about 4%. We could spend in excess of $1 trillion this year. So far, the tariffs have proven to be not a big deal. Do you think we'll have the same kind of volatility in 26 for tariffs, Matt?
I don't. I think first and foremost, I think we kind of got really the gist of it out of the way this year and really in the first half of this year. But I think the other big reason is that midterm elections are coming up. And if we see this kind of volatility, that'll probably affect consumer sentiment and not be great for Republicans' shot at midterm elections. So I think because of that, they'll dial down the tariff rhetoric.
Yeah. Look, some of the imbalances have to be fixed. Some of the things like a Harley Davidson motorcycle in India, or it's how oil is used to finance the Ukraine war. This week, there's another last ditch effort by Europe to try and get the Ukraine war solved. I don't think you solve it until you fix some of these things and tariffs on oil, specifically Russian oil. We're actually hopefully going to slow this thing down, or sanctions to a great degree. I guess to a point, I think Matt's right that the tariff issue becomes a rear view mirror issue. We do still got to figure out China. China's a bit of a problem, especially around with lithium. I think that's one that's out there. Matt, I don't know if you would agree. That to me is and Canada to a degree about auto parts and so on. But to me, I think if we can get through the lithium piece, and there's a lot of industries in the United States suddenly very focused on domestic lithium manufacturing. But to me, that's the last piece there, man.
Yeah,
Oh, go ahead.
I would say, when it comes to critical resource manufacturing like that, that's something the U.S. has done historically. But again, as things got cheaper in China, we started offshoring a lot of it. So I think we will start to see definitely some nearshoring, or what's the term, friend shoring, bring it
Friendshoring,
to
yeah.
places like Australia instead.
Yeah, for sure. All righty, Matt, switching gears. One of the things we've talked a lot about, this kind of K-shaped economy in the guys, or bifurcation between the wealthy and the not who are not wealthy. What are you seeing from the data standpoint? Can you describe this quote unquote wealth gap? And it was a tough one, but I love your thoughts on it.
Yeah, so you mentioned something, the K-shaped economy. In general, it literally looks like the letter K whenever we talk about that, right? If you look at a capital K, the first section kind of goes up and the second section kind of goes down. And that's in essence what a chart really looks like in this bifurcated economy, where the top 10% have a lion's share of assets in the country, and then the bottom 50% has much fewer assets. So as it stands right now, the top 1% holds about a third of the nation's wealth. which is about 12 times more than the bottom 50% of the country's population. So that's where that K comes from. In terms of how it's impacting data, I mean, spending has always been driven. If you look at things like retail sales or really even GDP, personal consumption, those are really driven by the top 25% of consumers. So we're left in this state where retail sales data has been holding up quite well this year. GDP has been doing pretty well this year outside of some tariff-related noise in the first quarter. But what's been struggling this year has been sentiment. And that's because sentiment indices will go out to everyone, not just the top 25% of consumers. So you're in a scenario where hard data like retail sales shows that the economy is moving forward at quite a strong pace. A lot of consumers feel excluded from that booming economy.
Yeah, and everybody, look, there's always been rich and poor, and that's a reality. But since 2008, when the federal government printed money, folks who own a house or own a car, or own liquid assets in the stock market or the bond market, everything got pushed, inflated, everything went higher. So the byproduct has been what Matt's hit on. The top 1% own 30% of the assets, the 33% of the assets, the bottom 50 own 3. The people over 70 years old are far and away the most wealthy class and spending prolifically, by the way. So there is this issue. But Matt, I mean, I come back to the same thing, which when I look at, this idea of where wages are going, to me that suggests that at least they're hanging on there. What do you think going into 26? Any idea if the bottom 50 see a catch up? I'm excited about where wages have been and where they're going, but I want your opinion.
Oh, I think there's definitely some positives going into next year. As you mentioned, wage growth. If we think about real wages, that's essentially your wages outpacing the rate of inflation, so you get real wage growth. That's been a positive trend for 29 consecutive months now, where we've seen wage growth outpace inflation. So that's obviously great for consumers. And we also have things like no taxes on tips upcoming in the next year, decreased salt taxes, state and local taxes for next year. So I think those will all be very helpful for the lower and middle income consumers. However, there are certainly some challenges ahead. Housing is still very unaffordable. As you mentioned, housing as an asset is one of the things that's inflated the most since 2008. So it's really been a has and has not kind of economy for those who didn't own a house, who didn't have investments in the stock market. It's been a challenging last decade and a half. So I think housing is still an issue. And then I also think what's going on with healthcare right now could definitely raise some questions.
Great
Again,
point.
insurance premiums rising. If we don't figure out a solution for healthcare costs, that'll also be a burden, especially for lower income consumers.
And that means 100 million people still just hang in there, and that's not great. We want them to do better. I do think a manufacturing renaissance where there's better, higher paying jobs available will help some. I think AI productivity brings inflation down, so that'll help some. But to Matt's point, it's hard to make them more wealthy. The wage piece is exciting, though. It's allowing them to at least hang in there. And look, have they ever been more than hang in there? Sure. There's been times in the 80s where they were doing quite well. There's blips of moments where but by and large, when we exported a lot of our manufacturing in the United States to somewhere else in the world, that changed the narrative around wages in that lower rung. I'll give you one reason why I'm very optimistic on this front, though. Over the next 15 years, basically $100 trillion will go from the boomer generation to everybody else. And I think it goes to multiple generations, to Gen Z, Gen X, Gen Y. And we already saw this year, just this year, 1.7 trillion moved from the boomer generation to everyone else. And in that movement of money, I think you get debt destruction. I think you get people maybe they inherit a house or just money or both. And I do think that movement of money from the boomers to everyone else will be an economic miracle that really helps the growth of the United States. But to Matt's point, right now, those folks on the bottom are struggling a bit. So when you see prices be a little bit higher, specifically because of wages, you're going to McDonald's and they're now making 20 bucks an hour in New Jersey. Don't be mad because those people they need that money, and I'd argue that that's a boom to the economy that we haven't really appreciated, and I think I'd love to see this trend continue where inflation falls to 2.5%, and wages stay at about 3.5 to 4. That would be the ideal scenario. Let's see. Maddie, awesome. Thank you for joining me. I'm going to have you come back on at the end, so don't go away yet. We got some good final wrap-up questions for you. Now, my partner, Jamie Desmond. Jamie and I have worked together for many, many years. She's an extension of the research team. She is the Chief Operating Officer of Ladenburg Asset Management. She's on part of the Women's Committee here at Osaic, and someone who's a trusted partner of mine for many years, as well as one really smart person. Welcome, Jamie. Thank you for joining me.
Thank you. I'll make mine brief since we're running so far behind
Oh,
schedule.
don't worry about it. We knew these were going to be a little bit longer. It's fine. We were excited that you're here. So as we talk transition to holidays, Jamie is famous for being able to host 20 people in the blink of an eye. She's always got basically a fallout shelter in her house where I'll talk to her on a Saturday. Hey, how was your Friday night? And she go, 20 showed up, so we had a party. You're really good at that, Jamie. So, Jamie, as we switch to Thanksgiving, excuse me, as we think of the holiday season, one of the things we talked a lot about was Thanksgiving more expensive. And we did a piece on this. And I'd love your thoughts on someone who ultimately entertains quite a bit. But also, what did Thanksgiving look like from a broad-based cost standpoint? And how is spending on the holidays so far shaping up? Are consumers still spending?
Well, shout out to our research team that puts together great white papers, and their wittiness shines through, as the title of the Thanksgiving one was Bird That Beat Inflation. So, actually, while CPI shows that food is up 2.7% year over year, we didn't see that actually carry through to Thanksgiving. Many of the broad box retailers actually price Thanksgiving meals at a discount. So the turkey and the sides ended up coming out to about an $80 meal for 10 people. Now I had almost triple that. So I
I was
did
gonna say, how many
spend
people did you have at your house? Wait a minute. That's
24
not
people sat for dinner, and we did two 22-pound birds. So I'm never, when it comes to food, I'm never kind of with the national averages. But the good news is that Thanksgiving was affordable. There were people that had to make changes or sacrifices, swapping out turkeys for chicken. There were some really interesting examples that were given, but in
Yeah,
general,
actually,
the
let me ask you a
holiday
question.
spending's up.
Around the holiday table with your family, did that come up at all? Where folks still feel like it was a little cheaper or better? You have a great a huge family, but a cross section of all kinds of people. I'm curious, did it come up at all?
I think we certainly had our complaints. You know, the egg prices. I feel like I haven't had a holiday meal in 3 years that we didn't talk about the price of eggs. But that was obviously an anomaly that have happened there. But in general, yes. I mean, we are hearing the most talked about thing that I find is groceries, because that's something that hits somebody in their pockets week over week. But on the other hand, as you cover on the podcast quite often, you know, the price of gas is so much cheaper that no one's remembering that it
Good
was
point.
$10 left to fill their tank, so they had $10 more to spend at the grocery store, but it did cost them $10 more at the grocery store. So overall, I think the consumers generally in good shape, to your point that you and Matt were discussing about wage increases recently.
That's a great point. You forget everybody. There's been prices I saw last week, 178 in the Midwest of the country for a gallon of gasoline. Now, by me, it's still roughly two. I paid 271 the other day. So,
Ooh, I
Jamie,
paid 274 yesterday, so you beat me.
oh, and there's a lot of stats on this. My favorite stat was for every 10-cent drop in the price of gasoline, the consumer spends 35 to $50 billion more. But Matt talked earlier about tariffs, and we didn't hit on it, but lower gas prices have a direct impact on tariff costs. So on that, Jamie, what's the take on holiday spending? Are the consumers still spending? What are the expectations going into this year, finishing up this year and into next year?
I think some of the numbers that you often talk about surprise clients when I see you out there talking to audiences. We spent $40 billion on back to school. Halloween, $10 billion. That's a number that people can't really fathom, adding up candy and costumes and hosting and parties and everything else. And the consumer is expected to spend nearly $1 trillion over the holiday season. So in general, maybe down, you know, from recent spending, but up overall year over year. They're estimating about 4% more in spending costs for this holiday season. So we're, as you and Matt talked about, we really feel the consumer is supported. They're employed, and their wages are increased. And while prices are hopefully, you know, averaging out to be slightly up, people are not hesitating in their spend for the holiday season.
And that's important because remember, 70% of all of the growth of the United States today is the consumer. And if we do get a manufacturing renaissance and we go from 11% where it is today to 15%, that would be a big deal. For fun, Jamie, what's the number one manufactured product in the United States today? You know this answer.
That would be agriculture, of course.
Yeah, I knew she'd get this. She hears me talk about this stuff all the time. For fun, what's the number two that no one ever gets right?
No one ever gets this one, but I've heard this speech too many times. So education, we educate the world, and hopefully we will be able to maintain some of that smartness that we share.
Why?
Interesting though about the holidays. Another thing we don't often talk about, but the holiday travel, going back to the gas prices, also has a big impact. So Thanksgiving travel was expected to be down by 18% in total cost, but that's because more people opted to drive than fly. As you and I, who fly around hundreds of days a year, know the price of airline tickets has gotten just out of control. And some of the numbers that I saw kind of build on the conversation that you and Matt were having. It truly is a K-shaped economy when it comes to travel. So the luxury and the five-star hotels and the first class tickets are selling out, whereas those that are on a budget, the cheaper discount airlines that's where people are opting to drive. So overall travel kind of stayed up, but it was definitely a bifurcation between those that could spend and those that have had a budget and hold back.
Yeah, first class tickets being oversold or back in the back of the plane, not so much. I mean, really fantastic points. And why I mentioned manufacturing and education, Jamie hit on, and all these things, when you put them all together, if you can grow the U.S. economy by greater than 3%, or at least that 3%, and you get a manufacturing renaissance, then you get a stronger U.S. consumer, stronger spending overall, and a much healthier United States. By the way, maybe we can balance our budget in that scenario. This stuff all connects everybody. The economics connect. Grow the U.S. economy, generate more revenue, pay down your debt. I mean, that would be ideal. But to her point, if the consumer spends, whether it's because of cheaper gas or saving a little money, we see big box stores like Costco doing better than some of the smaller, then we have an opportunity for great great fun. All right, great fun, great growth. Maddie, come back on, everybody. So now let's wrap this thing up because we're a little bit long today, but that's okay. This is holiday time. We're allowed to be long. Jamie's a very punctual person. She doesn't want me to be too long, so she goes crazy with this stuff, but she keeps me on track most days. Not today. I get to decide the podcast. She hates that, but I do. She hates all the cheese too. So we're gonna go right to cheese. So Jamie, what is your favorite Christmas cookie?
Well, I don't know if you all know, but not only does Phil make sauce, he has mastered his mother's amaretto cookie recipe. And I get a dozen every year saved aside for me. I am not a sweets person, and I definitely like the amaretto cookies. I'll tell you my least favorite. This weekend, I tried to use the cookie gun and make sprinkle cookies. And it after an hour wasted on the cookie gun getting stuck, I decided to just roll balls and make shapes because I was trying to get my Christmas cookies done, and that was quite a pain.
It's true. I do love my amaretto cookies. So that's funny. Listen. I can't undersell this. She can cook for 20 in a blink of an eye, and there's nothing she can't cook to her credit. She even makes a really good lasagna. So kudos to her. Maddie, what's your favorite cookie?
I'd have to go snickerdoodles.
Do you make them or just eat them?
Well, both.
Okay, all right. Matt's a good cook, by the way. Matt, to his credit, hosted Thanksgiving dinner for his mom and dad, his brother, his girlfriend, and then am I leaving anybody out? Did her parents
Her
come?
parents?
No, it was you got everyone.
Okay. And he got a multi-course dinner in a little apartment in Manhattan. So kudos, Bronx, whatever the hell you are. Kudos to you, buddy. That's impressive. But so you make your snickerdoodles. Okay, that's good for you. Well, this year you'll get to try amaretto cookies if I can get around to making them. All right. Plans for the holiday. I'll start with you, man. What are you doing for the holiday? Anything fun?
I'm flying out to Oregon to visit I'm going with my girlfriend. We're seeing her extended family. So it'll be my
Oh,
first time meeting everyone out there.
Ooh, good luck.
oh boy. For a young guy, this sounds like a very serious move there, buddy. Oh, but best, don't talk about politics. Don't do that. Bring some really yummy stuff, like a good bottle of wine and some desserts from New York. That'll score big points. And I can help you with that, with the bring. And
He'll
most,
make the homemade. He doesn't need to go to a local
yeah, that's
bakery.
true. No, that's good. And most importantly, remember everybody's name. If you do that, you'll score big points.
I'm already getting trained up, so hopefully I'll be ready by the time I get there.
I've met his girlfriend. She's a doll. She's a tiger. So good luck. If her family's like her, woohoo, you're in for some heavy lifting. Matt can handle it. Matt's that guy. Jamie, what are you doing?
I am hosting family. We're excited to have my brother and sister-in-law visiting from England and our 14-month-old nephew. So we get a baby crawling around Christmas presents by the tree. It's gonna be a lot of fun.
Oh, that's amazing. I'm sure she'll cook for like 50 just because she does.
I'm hosting Christmas Eve, which Phil and I share a similar tradition, which is the Catholic seven fishes. So, although we do the fun ones, we do lobster tail and king crab legs and oysters. Not so much the traditional fish, but
Yeah,
it is
I'm
my
gonna,
favorite meal of the entire year, and I'm happy to host it this year.
I might have to come over. I mean, it is
You're
my favorite
welcome.
year of the whole meal. Since my dad died, it's not exactly the same, but that's right. I'm working on making it better. We do eat weird things like bacalao, which is dried catfish, but she's quite good at it. We share a love of that stuff. All right, well, both of you, thank you for joining. You can hang on. I'm going to wrap up in just a second here. First off, I got to send a hello to my friends from the Glassner Carlton group. I met a group of young folks who are really into their craft, very folks who really care about the what they do every day. A really talented young Jersey group. You know, it's funny. I joke around. Everyone makes fun of New Jersey, and justifiably so. I think terrible football. It's are crowded. It's traffic. It's expensive. Our politics are hilarious. Our taxes, but it's my house. I live here. And we have great beaches. Jamie lives out down at the beach, and we can get to anywhere in the world with a blink of an eye. But if you're from Jersey, it's a bit of a different attitude. It's a pure Jersey group of people. Then we have a lot of good quality mosaic people in New Jersey. So we joke I'm going to do a Jersey food tour. So if you want to join me on the Jersey food tour, we're going to get a bus. I'm going to tour around the 4 restaurants, and you're welcome to come and join because we like our Jersey stuff so much. My shout out of the week's a little bit different, and maybe Matt or Jamie can add to this. If you get a chance this holiday season, watch It's a Wonderful Life. I know it's an old movie and it's not that exciting. I watch it every year, and I caught a piece of it already this year. But I thought about it 'cause I read someone wrote a little piece on it, and I can't help but reiterate it. So I'm not going to use a person this week. I'm gonna talk about a topic. I think at this time of year, the movie why I think is so powerful because the movie talks a lot about the perspective we all have on life, the impact that we have, and that to me the most humanity, when we're most connected is this time of year, whether it's the new year rolling through or the fact that we just want to do those little things extra, that everyone is relevant and that, we all matter and you're not alone this time of year. I saw the terrible tragedy in Australia and at Brown University, and these things they're damaging. My heart goes out to both areas, especially once again, in the middle of Hanukkah, for folks in Australia dealing with another massacre. But I hope we can take a step back this time of year and enjoy the perspective of It's a Wonderful Life because we all matter in the end. We all do our little bit, a little part of it. And actually, I'll mention something. I was recently given an award of Chief Investment Officer of the Year, a Luminary Award. And I only mention it because that award's not mine. That award belongs to the whole Ladenburg Asset Management team. But I think we got the award because this is our little part. This is our little way of giving back to you all and hopefully helping you with your finances or giving something fun to laugh about. But most importantly, watch the movie, and I hope you take away the perspective that this time of year everybody matters a little bit, and hopefully we got a chance to maybe shake hands or give a hug or share a toast or something and enjoy it because the next couple of weeks here are that time to do that. Jamie or Matt, would you add anything to that?
I'd say, Phil, along those lines, family matters a lot to you
Yeah.
and me personally. But in the spirit of the holidays, hopefully everybody has someone to spend it with and to celebrate ending one year and starting a new one fresh. And I'll give a shout out to my family. My nephew is proudly a wrestler at Penn State, which is my alma mater, which I'm sure many of
Right.
you know. And he had his first match this weekend, wrestled up 2 weight classes, and came home with a big win. So super proud to have him representing the Desmonds at Penn State, and proud of him because he's worked his entire life to achieve such a goal, and he's off to a great start. So big shout out to family for the holidays from me.
He's a beast, that guy. He's such an impressive young. Look up Nathan Desmond. You will be blown away. And his sister, by the way, Nicole Desmond. We'll save that for next time. Matt, any final comment there, buddy, before we wrap it up?
No, I just echo the same sentiment as you guys. Happy holidays to everyone. It's awesome having, not only the impact on our immediate people, but also knowing that we get to help thousands of people through what we do through our work. So that's awesome. And my special shout out, I'll give you one, Phil. It's Dick Van Dyke. He turned 100 in the last week.
Oh,
That's a great. You ever seen him dance, like really dance? Oh my God. The guy, like he could float. I think it's a great one, especially at Christmas time. He was big on Christmas. Scrooge. I mean, Scrooge, the chimney sweeper. Well done. Both of you are awesome. You guys made the podcast special. Sorry we went a little long this week. It's okay. Hopefully, I know so many of you listen and enjoy when we have guests on, and you guys crushed it. Thank you so much. Have a wonderful week, everybody. And next week, we'll have some more fun wrapping up the year as well. 2 more guests next week, and then something fun for the last week of the year. But thank you for listening. Have a great week, everybody. Talk to you all soon. Bye-bye.
thanks. Happy holidays.